Hello, how are you students? In today's session, we are going to discuss about the IFRS 15, that is LKS 15, revenue from contracts with the customers, revenue from contracts with the customer. Here we are going to see how we can recognize the asset, how we can recognize the price and revenue from the contract or sale, how to recognize the income. That is the one here we have mentioned. Right here, first of all, in the contracts we have to identify the contract. One is contract, we have to identify the contract, right? Second one is the obligation. Contract, there should be a contract, right? The contract may be in written form, on oral, or implied term. The contract may be oral, implied term means it is understood, right? So when you do a purchase from a grocery shop, that means if you are buying an if you call rice or anything, that's a contract between you and the grocery retailer. That means it is implied term. There is no oral contract, or there is no oral contract, there is no written contract, but it is an implied contract, the contract between you and the retailer. You are purchasing a rice, then the rice should be in the usable quality of human. It cannot be in unusable stage, right? So price also should be in the reasonable price. You are agreeing with the price. You are impliedly you are entering into the contract with him, right? He also entering the contract. That is the grocery he is supplying should be in usable stage. Otherwise, you can return it and change it, exchange it, change it. So that is also one of the type of the contract. That's what I said. There should be a contract, right? There should be a contract, right? There should be a contract, and there should be a obligation we can see later on. Contract also we will see. First of all, there should be a contract, there should be a obligation, there should be a price, right? There should be a price, determination of price, and allocation of price, and recognition of revenue. These five should be satisfied, right? All these five should be satisfied, right? First of all, identification of contract. Contract price is approved by all the partners to the contract. Partners to the contract means seller and the buyer, right? Seller and the buyer. So when you are purchasing a goods, partners to the contract, you and the retailer, you are agreeing to the price. That's what the contract price is approved by all the parties, right? Second one, the rights and payment terms can be identified. Rights, what is the right to you? If the goods is not in usable state, you can return it back and get the cash refund, or that is a rights. Payment terms, whether it is ready cash payment or whether it is in the installment method, like that, payment terms should be identified. Contract has a commercial substance. The contract should have a commercial substance. There is Commercial substance in the sense, how can I explain you? It is in the marketable, commercial, marketable. It is the product is in the what you call in the process of market. It is in marketing. It is available in all the markets. It is saleable. That is what they said. There should be a commercial substance with the profit to to earn a profit, right? It is a probable that revenue will be collected. It is probable the revenue can be collected. If you supply some goods, you have to get the revenue. Then only there should it is recognized as the contract. If you are for free supply, there is that is not a contract. Identification of performance of obligation. If the goods or services that have agreed to be exchanged under the contract are distinct, then they should be accounted for separately. The goods which are you are supplying should be distinct in the sense should be separately identified, right? In the case if you are selling a if you say if you are selling a phone to the customer, or if you are selling a computer to the customer with the technical support or warranty mean the sense within 2 years warranty you're offering with the cell phone, mobile phone, or with the computer. You say I will give all the free services for next 2 years if you purchase this, right? Then there are two types of products involved. One is sale of goods, another one is sale of services. Sale of goods and services. Sale of goods, goods and services. So goods is mobile phone. That is technical support. It's the services. Right? So you should be able to distinct the both thing. The products. What is the goods? What is the value of the good? What is the price? Right? So that is what they distinct. Determination of transaction price. The amount the selling party expects to receive is the transaction price. That is significant financing components, variable consideration, refunds and rebates. The price should include the amount that is variable rebates. If there is a rebates, if there is a discounts offered, that should included in the price, right? That's what they said. The determination of transaction price. Determination of the transaction price. You have to determine the price. What is the price? The amount, right? The price, the amount the selling party expects. The amount selling party expects to receive is the transaction price. The amount the selling party is expected is the transaction price. That means if the transaction price involved any financing component, that means any interest, like financing component in the sense significant financing component in the sense interest. If you say it is in the duration, if you are selling the computer on the installment basis for 2 years, right? Install under the installer, for you will charge a interest. Maybe the charges the charges you charge for the 2 years, it is called interest. It may be a hidden charge involved in the price or unhidden, right? So that was a significant financing component. That is what we say interest components, right? Variable consideration, any other consideration involved in the transaction, and refunds and rebates. If you say after 2 years we will refund this much, uh, or discount, we will give a discount. If he discount, you give the discount at the earlier stage, they will give the discount. Otherwise they will keep a security deposit or something, they will refund at the end of the period. So refunds and rebates, that's what. And allocation of price to performance obligation. Allocation of price, the price is allocated proportionally to the separate performance obligations based upon the standalone selling price, right? These all are contained in the accounting standard, right? So what they says is, okay, what they says is, uh, there are circumstances where in the market you say they will sell the computer separately, and technical, what do you call, free services after sales and services, maintenance services for 2 years. 2 years, right? They may provide the seller will provide computer, may sell the computer, and computer maintenance services also he used to provide. You can purchase the computer for 20,000, right? And maintenance for 2 years, 5,000, right? 5,000, right? 5,000. Computer for 20,000, maintenance for 5,000, right? But for 2 years. If you purchase separately, if you purchase computer, and if you purchase, if you do the maintenance package for 2 years separately, this is normal situation. The now the new trend is there. The seller used to, this is maintenance package, right? Service package, okay, for 2 years. Now the seller will providing services. Now he will sell both together, as a one package. He will offer 23,000. If you purchase both together, you will get it for 23,000. Right? If you purchase separately these two packages, two things, you will get incur of cost of 25,000. Whereas if you purchase it today with the two together, both together, you will get the 23,000. You will pay 23,000. 2,000 you will get a profit. You get a discount for 2,000. That's what they says. Allocation of price to performance, right? This is called as standalone price. This is called as stand alone, right? Stand alone price. right? This is called standalone price. Standalone price, right? This is called standalone price. This is the normal price. That's what they say. The price is allocated appropriately to the separate performance obligations based upon the standalone selling price. Yeah, if you sell it this at this stage, they want to know you are selling both together, so how you can allocate the price, right? That is the fourth one, allocation of price to performance obligation, right? First, a determination of transaction price, the amount selling party expected is the transaction price, that is significant financing components, variable consideration, refunds and rebates, that is earlier. Allocation of price per performance obligation, the price is allocated proportionately to the separate performance obligations based upon the standalone selling price. Standalone. Based on this, they want to know whether you can allocate the price to the separate obligation. There are two obligations, right? Computers, supply of computers and supply of maintenance services. Whether you can determine the prices, allocate the prices, standalone price to this. Yes, we can. How? Here you get, right, 23,000, 23,000 divided by 25,000 into 20,000, right? So you will get rid of this. This is 5, this is 4, right? Let's see how it will come, work it out. 23,000, sorry, 25,000, yeah, 23,000 divided by 25,000 into 20,000, that is 18,400. This is 18,400. Okay, this is 23,000 divided by 25,000 into 5,000. This is cost. 23,000 divided by 25,000, right, into 5,000, right? That is 4,600. This is 4,600. This is the no actual selling prices to this. These are the actual selling prices to this. If you add these two, right? If you add these two, you will get this, right? Okay, understood? This is the standalone price. This is the individual prices of both this. So from standard alone price, we can calculate the individual prices of these separate obligations. That's what I said. The price is allocated proportionately to the separate performance obligations based upon the standalone price, right? Recognition of revenue when as performance obligations are satisfied. Recognition of revenue will be recognized when the transaction took place only, right? That is once control of goods transferred to the when the control of the goods transferred to the customer, end user, right? customer, the performance obligation is satisfied and revenue is recognized. This occurs at a single point of time. We should consider the following. The recognition of the revenue, it take place when you transfer the rights of that particular product to the customer, right? The transfer of rights, transfer of rights to customer, seller, from seller, from the seller, transfer of rights to customer. You are transferring rights to customer. At the after transferring only you can recognize the revenue. After transferring the rights only you can recognize the revenue, right? That is okay. Present the following, we should consider the following in assessing the transfer of control. Point of time, at the point of time, single point of time, right, occurs. Present right to transfer the control. Transferred legal title to the asset, right? Transfer the rights, control, right? And transfer the legal title to the asset. Transfer of legal title, right? Once if it is the property, then the legal title it transferred to the customer only, owner only, it will be recognized. Transfer the physical possession of the asset. Transfer of physical possession of the asset. When you hand over the what you call the asset to the customer, transfer risks, rewards of ownership to customer. Customer has accepted the assets, right? Transfer the rights, right? That's what they say. Risk and rewards. If you say, if you purchase a building, right, it is still not, they have not transferred the legal title or what you call possession is in with the seller. And if there is any, if it is destroyed by fire, the building, if the building was destroyed by the fire, then the seller has to accept the losses because he still not transferred the rights or rewards or risks to the seller, because he didn't transfer the ownership of the asset. He is possessing the assets still. Then that's what they said, risks and rewards of the ownership to the customer. Risk and rewards, when it's risk and rewards transferred from the seller to the customer, when you transfer the legal title and when you give the possession to the buyer of the asset, right? When you, those are the, this, everything is interconnected, one is connected to the other, right? Custom has the accepted, that is for this. Here specifics principal and agent, there is the supply of goods through agents, right? Principal through the agents. When a third party is involved in providing goods or services to customer, the seller is required to determine whether the revenue of its the nature of its promise is a performance obligation to provide the specified goods and services itself. That means principle itself. Provide the specified goods or services itself. If you yourself providing the services in the sense principle. Arrange for the third party to provide the sales and goods or services is an agent. Is an agent. Right? That is what these are the type of this thing, right? Questions, right? Questions. Lucky and Company sells a car, right? Question number 1. Lucky and Company sells a car to a customer for 10,000, right? Offering interest-free credit for 3 years. 3-year provide, right? They have provided a car, right? On credit, offering interest-free credit, period. The car is the annual market rate of interest on the provision of customer credit to similar customers 5%, right? 5 normally he sold the car for 10,000, right? 10,000 rupees. 10,000 10,000 free of interest, free of interest, right? Free of interest, right? For 2 years or 3 years he is selling, right? So market rate of interest is 5%. 5% market rate interest. So what they say is, what is the transaction price? What is the transaction price? What is the transaction price? Right? Transaction price, okay, 10,000 into 1 upon 5, right? 1 upon 5, that is 0.8638, 0.8638, right? 0.8638. This is called, right? You have to refer the table, right? Table 10,000 for 5 years, 1 year 5%. How much, right? So 1 year or 2 years, right? The company sell a car for to a customer offering interest-free credit for 3 years, right? 3 years. Annual rate is 3 years. 3 years. Interest rate 3 years, right? For 5. You have to take, they refer the table. So how much? 8,638. This is the transaction price. This is the transaction price. What is the interest component? Interest component is, you have to deduct it and get it. Balance is the interest component. This is the transaction price, right? And we will recognize this is the transaction price, and this is the interest. Interest is, right? You have to calculate the balance is interest. Balance interest is 1,462. 1,462. sorry, 362. 362. This you have to, this amount you have to spread it over 3 years. Spread it over 3 years. First 3 years. Spread it over 3 years. 3 years. Right. First year how much divided by 3, and first year this one, current year liability and previous year liability, non-current liability and current liability you have to show it, right? Number one, question number one is over. Question number one is over. What is the transaction price? Only they have asked. This is the transaction price. Okay. Balance is interest component. Okay. The Rock and Company sells home entertainment system. Sorry. Rock and Company sells home entertainment system including 2-year repair and maintenance package for 10,000. Home entertainment system, right? Price of home entertainment system, and what you call repair and maintenance, 2-year repair, repair and maintenance, right? This is this system. This is standalone price. Standalone price. Standalone price. These are the individual price. Right. Allocation of standalone price. Allocation of price. Standalone price. Right. Okay. Right. Here they said the Rock and Company sells home entertainment systems including 2-year repair and maintenance packages for 10,000. This is the 10,000 is the standalone price, right? Standalone price. They provide price of entertainment system and 2-year maintenance. This is standalone price of this 10,000, right? And the price of the home entertainment system without the repair and maintenance contract is 9,000. Without repair and maintenance, individual price is 9,000. 9,000, right? And the price to renew 2-year maintenance package, to get the 2-year maintenance package is 2,000. 2,000, right? So altogether, if you buy 11,000, right? If you go for this, it is profitable by 1,000. So 2000. How is the 10,000 contract prices allocated to the separate performance obligations? Note, ignore any discounting and time value of money. Discounting and time value, right? Discounting time value, they ask us to ignore it, right? So 9,000, and here for a number one is product number one. This is product number two. For working for number one, working for number one, for one, working for one, right? Here they said total price is 11,000. Total standalone price is 10,000, right? Divided by 9,000. Sorry, 10,000, 9,000. Sorry, 10,000 divided by standalone price divided by all together price into 9,000. Price component of the price. This is the standalone price. This is the total price of the individual components, right? Into individual component. That is 8,182. This is 8,182. Right? 8,000. Working for one. Working for two. 10,000 divided by 11,000 into 2,000. Right? It is equal to how much? 1,818. 1,818. So get the total, right? It is 10,000. Right? This is 8,182. Price allocation 1,818. This is the price allocation for individual components. These are the individual component 1, component 2. Working for component 1, working for component 2, right? Okay, this is the way you have to do the allocation, because total price is this is the standalone price, this is the standalone price, right? This is the total price of individual item. Total price of individual item selling prices. Right, selling price. This is a, so price of the entertainment system 8,182. 2-year maintenance is 1,888. It's the cost. But if you go for the individual purchasing, you will have to pay 9,000. You had to pay, instead of 1,888, you had to pay 2,000 if you go and buy individual. But if you buy both together, the cost for you 8,182 and 1,880. Right? Understood? This is the question number 2. Question number 2. Right? So we will go and see for the question number 3. Question number 3. Mark Mobile sells mobile phones selling them for free when customer signs up for a 12-month contract. I am going to raise it. This is Mark Mobile sells for mobile phones, selling them free when a customer signs up 12-month contract. Right? The contract cost the customer 4,500 per month. Right? Mark Mobiles sells the package of they are selling the they want you to calls and data. Okay, data. They sells calls and data, right? Package, right? For 4,500 per month for at the rate of 4,500 into 12 months. 12 months, right? Then they provide the free free mobile phone. Then they will provide a free mobile phone to you. Contract cost the customer 4,500. 4,500 contract cost, right? Explain how the revenue should be recognized in Mark Mobile's financial statement. Note: Vodafone sells mobile phones without monthly contract, selling the handset for 4,800. Right? This is the Vodafone sells mobile phones without a monthly contract. Without monthly contract, this is monthly contract, right? This is monthly contract. This is for monthly contract, right? Without monthly contract, they say sell package at the rate of 2,000 per month. 2,000 per month. 2,000 per month. Right? Same package they used to sell 2,000 per month. Right? Without monthly package. Right? So they want to how they want to show us the revenue portion recognized in the financial statements, right? Here first, see, identification of contract. Yes, we have signed, right? One contract, Identification of contract. Yes, we have signed a agreement. Signed an agreement. Signed an agreement. Right? Signed an agreement. Yes, we have met the identification of contract. Yes, contract is there. Right? Second one, identification of performance obligation. Obligation. Right? Performance obligation. Right? Performance obligation. Identification of obligation. Identification of obligation. Yes, we have identified the obligation. That is, one is sale of calls and data package, and second one is mobile phone. Identification of obligation. Yes, we have identified the obligation. Contract. Yes, we have signed an agreement. That is the contract of sale. The identification contract. Identification of obligation. Yes, sale of calls and data package. One obligation. Second obligation is mobile phone. Right. Determination of transaction price. The amount the selling party expects to receive is the transaction price. Transaction price. Determination of price. Determination of price. Price. Yes. Calls, data and data package, plus this is one package plus phone. How much? That is 4,500 into 12 months. Right? 12 months. That is how much? For 4,000, 50,400. Right? 50. How much is 45 into 500? 54,000. Right? 54,000. 54,000. Right? That is cost and data package and phone. We have recognized the price. That is a standalone price. This is called stand alone price. Right? Number 4, they ask allocation of price to performance obligation. Allocation of price to performance obligation. Yes, we can allocate it. Right? That is, we can do, if you are selling. Yes, how we can make it the relation. selling price individual this is we can say mobile phone data call and data package, right? Calls. And if we can say like that, calls and data package for 12 months equal to what is 2000, 2000 into 12 months, right? 2000 into 12 months, that is 24,000, right? 24,000 individual price, right? Individual price of phone is 48,000. Then 72,000. Individual total cost of in total cost, right? Of in the item. Total cost of individual item. This is the individual cost, right? Individual cost. Individual item. These two are individual item. Individual item. Right? And next one is standalone price. Right? Individual price, and this is total individual price. Then standalone price is there for 54,000, right? 54,000 standalone price, right? Then price price allocation, right? They have said price allocation. So next one is price allocation for calls and data package is 54,000 divided by 72,000 into 2,000, right? How much? 200, 2000. That is 54,000. 54,000 divided by 72,000 into 2,000, not into 1,500. 1,500. Then phones, 54,000, 72,000 into 48,000. 24,000. Okay, 24,000. Then it is 18,000. Right. This 36,000. This is the price allocation for 54,000. Then if you get both things, 54,000. Right. Standard order price is apportioned. This is the fourth one. Right. Fifth one is recognition of revenue when as performance obligations are satisfied. Right. Performance obligations are satisfied for the mobile phone, at the time of at time at point of time, right? At mobile phones are recognized at point of time, right? The calls and data recognized recognized are recognized over of time period, that is 12 months, right? 12 months you have to apply, right? That is a question. Yes, 12 months. Mobile phone is at the point of time. Recognize the revenue of phone at the same period. The class, the calls and data over a time period of 12 months, right? For both are falling into the same year, no? So here no problem. You can show at P&L and the profit and loss statement, right? Profit statement of profit and loss, you will show revenue 54,000. 54,000. Right? Question number 4. Right? Question number 4. Silver Technology is a computer business. Right? Computer business that primarily sells computer hardware as well as selling computers. It also supplies and installs software to its customers and provides a technical support package over 2 years. right? They used to provide the technical support, right? Technical support for 2 years. And the combined goods and services contract sells at 1600 computer and servicing, computer and servicing, computer price to and services, right? Standalone price, right? Standalone price or combined price. That is how much? 1600. 1600. And uh, but if sold separately, they supply and installation is sold for individually individual price, right? This is allocation price, right? Allocation price. Individual price is, right? Where is my, this is allocation price, this is individual price. Individual prices are 1600, sorry, 1505, 1500 and 500. Service charge 500 for 2 years, 2 year service charge for 500, and computer is 500, altogether 2000, right? 2000. So what the lever tech uh, sold a combined contract on July 2017, right? This takes place on July number 1st July, 1st July 2017, 2017. They are telling, they wanted us to show uh, what you called combined, okay? They wanted us to show the statement of profit and loss account, statement of profit and loss account, and statement of financial position, statement of financial position, right? Statement of financial position and statement of profit and loss account. For this, we will say working working one, working 02, right? Working one, workings, right? Okay. Here they will say, they will take and demonstrate how the transaction would be presented in the financial statements for the year ended 31st December 2017, right? So here we will say working, common working, right? We will say computers, workings for computer, right? We'll say 2000, 1600 divided by 2000 into 1500. It is how much? 1200, right? For services, price allocation, working for price allocation, right? Services, this is 1600 divided by 2000 into 500, right? It is 400, right? It is 400, 400, right? Where, right? The computer we can show as a whole revenue, right? So 1200, right? Out of 400, he has to, he will receive only the 300, right? Because this is for 24 months. This is for, this services is for 24 months. This is for 2 years. 2 years. That is for 24 months. 24 months. Because this is July only this sales take place, then end of the December, right? 31st, 12th, 21/7, right? This also 31st, 12th, 21/7, right? 31st, 12th, 21/7, right? So if it for 6 months, time period is 6 months, first 7 to 20, 6 months, then 400 divided by 24 into 6, it is one fourth, right? Then for 100 only, this year's revenue, 100, right? So here we have to recognize the whole amount, this year revenue, right? Because possession is transferred. So 100, then revenue will be 1300. Revenue is 1300, right? Under the non current liability, non current liability and current liability, right? Deferred income, for that is, this is where, that is for 400, 400, that is deferred income 400 divided by 24 months into 12 months. 12 months. Then that is 200. Right? 6 months we have recognized here. Another 12. It's a deferred income non-current. Sorry, non-current is 6. That is 100. Right? Deferred income 400 divided by 24 into 12 months, that is 300. 300 and 100. This is non current liability, this is current liability, right? Why? Because calls computer, okay, within one then and there sales we have to take. For services, 2 year services are there. For 2 year services we are getting 500, right? So we, the period ending is 31 12 31 December, right? July 2017 is the transaction taking place, and we are preparing the balance sheet and profit and loss on December of 2017. Those for 6 months only we had to take this sales, right? For computers, okay, full amount we can take it, but for the services, computer services, it is the payment for 2 years. It is the payment for 2 years. The 400 is the payment for 2 years. So we had to spread it to the 2 years. This 400. 400 is for the 2 years. It has to be spread it to 4 year time. 2 year time. So this year's income is 100. Right? This year income is 100. This year income is 100. How? 400 divided by 24 into 6 months, right? That is what we have, right? 24, right? So total income revenue is 1300, but in the, we have got 400, whole 400 we have got now. We have received 400, so we 100 during the accounting period we have shown as a income. So balance 300 is there. Balance 300, it is a current liability. It is a deferred income liability. Deferred income we will have a separate accounting standards for deferred income. We will see in coming days. So here we will deferred income, we will show this as a 300 for 300 as a deferred income, right? 200, and this one is a 100, 300, 400, right? Deferred income, because you know why? This income is not relevant to current year, but we have received the income, it is payable, so we are saying as a deferred income. For 12 months payable we have to show it under the current liability, and anything payable more than 12 months we have to recognize as a non-current liability. So 6 months out of 12 months, 6 months we have shown here in during the period. Next 12 months we have shown as a current liability, and balance 6 months we have shown at a non-current liabilities. Okay, understood? So we will move into the next question. Question number 5. Okay. Question number 5. Performance obligation over time and statement of profit and loss on time and over time, at the point of time and over the period of time, right? Over, that is performance obligations at the point of time, right? Performance obligations take place at the point of time, right? At the point of until now we have seen the at the point of time. Now we will see at over a point of time, over the period of time, over the period of time, right? That is, Umesh commenced 3-year building contract during the year ended 31st December 2014 at contract period and a contract price of 50 million, right? Contract 2014, 2014 contract enters into the contract, tract, right? Contract price is for 50 million, 50 million, right? 50 million. Umesh entered 3-year contract, right? 3 years contract. Contract is 3 years contract, right? 50 million, right? And at the 31st December 2014, the cost incurred to date are 15 million and contract is estimated to be completed 40%. And at 31st December, the cost incurred to date is 28 million. 28 million, right? And contract is estimated to be 70% completed, right? Calculate the revenue and costs to be recognized in the statement of profit and loss for the year ended 2014, right? 2014, 2014, right? Contract revenue that is equal to 50 million into 40%, 40%, right? 40% is 50 millions, 40% is 20 million, 20 million. It is in millions, right? Millions, right? 20 million. Cost is to date and to be complete, right? To date, how much the cost to date? The cost incurred 15 million and the contract is estimated 15 million incurred, right? Cost incurred. Then this is how much? 5 million is the profit. Profit for 2014, right? At the December 31st December, the cost is 28 million. Cost to date is 28 million. This is for in millions, 2115 million. 2014 and 2015, right? 28 million, right? Cost is 70% is completed. 70% is, right? This is this is 50 into 40%, right? Next one is 2015, right? This is how much? 70% is 35 million, right? 35 million, that is 50 into 70 percentage, right? 35 million. Cost is 28 million, right? 28 million. Then 7 is the how much we have to say. This is a cumulative, right? Cumulative during the period. PNL to the period. PNL, how much we have to charge it for the period. Because this is cumulative now. This 20,000 also included here now. 35,000. So we have to say how much the cumulative. 35 minus 2015 minus 2014, that is 2015 minus 2014, right? That is 15. 28 minus 15 is 13. Then what is the amount? So 2 million. 2 million has to be shown in our accounts. Question number 5. This is Rex commenced a 3-year contract during the 31st December 2014. Rex starts a contract, right? 3-year contract. 3-year contract. Okay. Contract. Okay. So at the price of 50 million. 50 million. At the end of 31st December, the cost incurred to date are 15 million and the contract is estimated to complete at 40% complete. 40% completed in 2014. 40% completed. Okay. So do you say uh, revenue right? 2014, right? 2014, right? Revenue is 40% of 50 is 20 in million, right? In million. 20. Cost to date. To date. Cost to date is how much? Cost to date is 15 million. 15 million. Then 5 million is the profit, right? Contract profit, right? So calculate the revenue and cost to be recognized in the statement of profit or loss for the year ended 31st December 24. This is the one for 31st December 24. Cost is 15 and revenue is 20 to be shown in the profit and loss account, right? that you had to show. Second one, example number 6. Umesh commenced the 3-year building contract during the year 31st. Same facts, but right, same facts. 3-year building contract during the year ended 31st December 2014 at a contract price of 50 million at the 31st December 2014. The cost incurred to date is 15 million. We have did it, right? At the contract is estimated to be completed 40%. On 31st December 2015, the costs incurred to date are 28 million and the contract is estimated to be completed 70%. And in this is calculated like this, right? 50 million into 40%. Okay. In 2015, in 2015, 70% is completed. That is 35 million. That how much? 50 million into 70 percentage. Right? And cost to date is 28 million. So we have to deduct that. Then we will arrive at 7. Right? 7 million. Right? Some contract to be estimated at 70%. Calculate the revenue and costs to be recognized. This is question number 6, right? Next one is Chris. Continuation of 5, right? At 31st December, the costs are incurred 28 million and 70. Calculate the revenue and cost to be recognized in the statement of profit and loss account for the year ended 2015. Year ended 2015. PNL. So therefore PNL at 2015, right? How much in PNL we had to show? That is, you had to say 2015 minus 2014. You have to deduct. Then only 20 PNL 2015 will come. That is 20 minus 30, 35 minus 20 is 15, 28 minus 15 is 13, and profit is 2. Right? This is the revenue we had to show in our accounts, and this is the cost we had to show in our accounts. Revenue, profit is 2. Okay. So that is completed. And question number 7 is example number 7, performance obligations over time and performance obligation same as it is. And Umesh commenced a 3-year contract during the year ended 31st December 2014 at a contract price of 50 million. At the end of 31st December 2014, the costs incurred to date is 15 million and the contract is estimated to be completed 40%, right? And at 31st December 2015, the cost incurred to date are 28 million and contract is estimated to be 75% complete. Right? Umesh has invoiced the customer for a work completed to date as follows. Right? So we had to say revenue recognized (2014-2015). Revenue recognized how much? 20 and 35. 20 and 35. Invoice amount received, cash received, invoiced are how much? 16 and 26. 16 and 26. This is for, this is 9. This will be shown in the finance position, contract, asset, or liability. This is shown as a contract asset. So because it is the plus value, right? Plus value. If we have received more than what is revenue recognized, then that is shown as a liability, contract liability. This has to be shown as a contract asset, right? Okay. So this is the number 7. This is number 7, right? Number 8. Okay. The next one is, this is Alex commenced a 3-year building contract, right, during the year ended 2014, and continued the contract during 2015. The details of the contract as follows, right? Total contract value is 45 million, right? Total contract value is 45 million, right? And thereafter cost incurred to date is 2015 is 20 million. Estimated cost to completion is 12 million. Work certified as completed in 2015 is 15 million. Stage of completion is 2015. Stage of completion is 2015 is 70%, right? Profit recognized to date is 3.3 million. Profit recognized for the date is 3.3 million, right? So this is they wanted us to show how this contract would be dealt with the dealt in the statement of profit and loss account for the year ended 31st December 2015, right? He involves 2014 contract value is 45 million for 3-year contract. Okay, so we will see how we can tackle this question. So revenue recognized, right? Total contract value, total contract value is 45 million in million. 2014, okay, 2014, right, in million, right? The cost incurred to date is cost incurred, cost to date, right? Cost, uh, estimated cost to complete, to complete, cost to complete, right? Estimated cost to date is how much? 20 million. You have to deduct it. Cost to completion is 20 million, 12 million, sorry, 12 million, right? Work certified as completed in 2015, 15 million. Stage completion on stage completion on 2015 they want 32, 12 million. 12 million is a profit. That is not down to 15, 2015, 2015 this is 2015, right? 15, right? So stage of completion is 70, recognized profit based on upon 70%. So 70% of 13 million is, so based of completion, right? Based of completion, this is recognize the revenue of revenue is based on recognition of revenue based on completion, that is 13 million, right? That is 13 million into 70 percentage, that is how much? 30, 70 into 30, 70% into 30 million is 3 point, sorry, 9.1 million, 9.1 million revenue profit, revenue, cost and profit. Two thousand and 15, sorry, cumulative, right? Cumulative, and 2014, 2014 and 2015 cumulative, right? 9.1 million, 9.1, right? 2014, what is the cost they have given? No cost were given. They said 3.3 million is the profit, right? 3.3 million is the profit. 2015 we have said revenue is, no, revenue is cumulative minus 2014 equal to how much? 5.8, 9.8, right? Revenue is how much? 2015, what is the revenue? Work certified and completed in 2015 is 15 million. 15 million. That completed is 15 million. So if it is 15 million, if we getting the profit is 5.8 million, the difference is 9.2 million. 9.2 million is the cost. This is as the cost and revenue as a 15 million in the accounts. Okay, so let's move into the next one. Question number 8. This is in 2015 he started, and contract cost is revenue 2015, right? He started and revenue new is 40 million. 40 million, right? Cost incurred, right? To date is 25 million, right? So estimated cost of completion, estimated cost to date, cost to complete is 20 million, right? 20 million. So we have incurred a loss of 5 million, loss of 5 million, right? Show how this will be, right? Right. This is the total value, and in this is evenly commence building and contract 2015 seen large increase in future cost to complete. The contract will be scheduled, right? Stage completion is 45%. Stage completion is 45 percentage. Then completion cost or revenue, right? uh, how much the completion date revenue is 40 into 45 percentage, right? 40 into 45 percentage, right? Whole, for the whole contract. This is for whole contract. Okay, this is for 2015, right? 45 into 40 into 45, how much? 40 into 45, 18 million. 18 million, right? Cost to date is not known. Loss is 5 million. Now we have to write off the loss. If we know the loss, according to the prudence concept, we had to write off the loss immediately, right? So loss 5 million, so we have taken the 5 million here, right? Loss, and what is the revenue is 18 million. They have said 45, then 40 into 45 million, 45 percentage is 18 million. The loss is 5 million, then they haven't given the cost, right? They haven't given the cost, then we can calculate the cost balancing figure, right? 23. If you 18 minus 23 only 5 you will get, right? So this is balancing figure. This is balancing sing figure. This is how you will show in the SPL 2015, right? This is the statement of profit and loss on 2015. Revenue is 18, cost to date 23 million, and 5 million is the loss, right? The total revenue is 40 million. Total cost to date is 25 million in 2016, right? In 2016, right? Cost cost to be completed is 20 million, right? So 20 million cost to be completed, right? Then loss is 5 million. 5 million immediately we have to write it off. For the 2014-15 revenue is 45%, right? Stage completion is 45%, right? So stage completion, this is hold, then stage completion 45%. We know we are going to incur a loss, then loss has to be charged immediately to our profit and loss account. So we cannot do it in accrual basis. This is the prudent basis. Losses has to be charged then and there, right? Future losses also, contingent liabilities, everything. So we have charge the 5 here. This one we know 18, this is 5. So balancing figure is 23 million, that is the cost to date, right? So we had to charge, this is how we had shown in the statement of profit and loss account. Okay, with this, so now we have done so many questions, I think 8 questions, right? In the uh, revenue from contract with customers, IFRS 15 and LKAS 15. We have done 8 questions, and I feel you would have got a good picture on this standard. Okay, so I am going to conclude the lectures with this, and I hope to meet you in another accounting standard, okay, session. Thank you. Bye.